The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Happy Friday, live from Studio 2 at Bloomberg headquarters in New York. I'm Scarlett Fu.
And I'm Katie Greifeld. We're kicking off to the closing bell here in the U.S. And looks like we have a rally on our hands. The S&P 500 higher by about 0.8% right now. Big tech a little bit better. The Nasdaq 100 higher by about 0.9%. Looking to finish out this week on a high note. We know that has come with a lot of turbulence. You can see the 10-year yield selling off a little bit as we have this risk-on mood in the equity market. 10-year yields higher by about 3 basis points. Gold, there's a lot of action in gold. You wouldn't know by looking at the price, pretty much flat when it comes to the spot price of gold. You heard from the White House. Apparently, our reporting is showing that they're going to clarify what they call misinformation on gold tariffs. That was the big news overnight, Scarlett, that the U.S. was going to put tariffs on imports of gold, but maybe we're going to get some clarification there.
And who said Fridays in August are really slow, right? Wall Street's inability to string together back-to-back gains this week isn't stopping the S&P 500 from rounding out its best week since June and approaching a new high. But the buy-the-dip impulse has zeroed in on Mag 7 names and reduced the breadth of the rally, raising questions about whether U.S. stocks are overdue for a sharp pullback. BofA's Michael Hartnett says he is seeing investors take money out of equities and into cash funds due to renewed concerns on tariffs. Speaking of which, easy come, easy go. As Katie mentioned, a surprise Trump administration ruling that gold bars are now subject to tariffs, causing havoc in the global gold market. Refiners paused their shipments to the U.S., while gold futures, which are backed by bars shipped from Switzerland and other trading hubs, rose to a record earlier in the session. Now, in the last hour, Bloomberg has learned the White House will issue a new policy in the near future, clarifying that gold bar imports should not face tariffs. Beyond tariffs, President Trump putting his stamp on the markets and economy. Bloomberg has learned he is floating a potential $30 billion IPO of Fannie Mae and Freddie Mac after this week picking his nominee for a vacant Federal Reserve governor's seat before getting ready to select his next Fed chair. But Katie, when it comes back to it, it's still the story about gold, at least for today.
Absolutely. Again, you wouldn't know it by looking at the price, but it is a really interesting story. And I wanted to highlight actually the discrepancy, the dislocation you're seeing between the futures market and the spot market. Spot market, as we discussed, pretty much unchanged, but you did see futures really spike up this morning, as Scarlett mentioned, causing a little bit of a premium here. You can see if you just zoom in over on the end of the chart there that you saw futures trade higher than spot gold itself. That opened up a premium, and we'll see, of course, if these two lines come back together now as we await that clarification, Scarlett.
All right, good stuff. Thank you so much for setting us up, Katie, because let's kick things off with Aoifinn Devitt. She is Chief Global Market Strategist at Moneta. And Aoifinn, it's been a crazy Friday, certainly if you are in the commodities market, if you track gold, for instance. What do you think this ongoing confusion over what's going on with tariffs and gold really tells us about the fog of uncertainty that investors need to work through, yet somehow come ahead with this increased appetite for risk?
It's no surprise that we're dealing with this on a Friday afternoon. We have had a non-stop volley of news, and basically it's very hard to have any time to digest any of this, particularly in what is typically a slow summer month. So I'd say this is exactly the issue we're having with tariffs. We don't know what the transmission effect is going to be. Nobody does. It has seemed to have been less impactful initially than was originally thought. Now we think it may actually be more of a latent transmission effect because many firms have taken precautions to actually take some of their costs up front. So this confusion around gold is exactly that. We don't know who pays the tariffs. We don't know who's subject to it. There is trading on speculation. And we know that gold has already been a very hot commodity up to now because there has been that bit of uncertainty around fiat currency, around the intentions around interest rates, and so many other risk assets. So particularly thorny issue for investors.
Yes, particularly thorny issue, and one that really caught a lot of people by surprise, too, because gold was the last thing anyone thought would be subject to tariffs in this way. What does it say, Aoifinn, that we kind of lurch from one theme to the next, from week to week? Last week, at least at the end of last week, it was all about this idea that the economy is not as resilient as we thought. And then this week, we're getting back to the idea that these tariffs can still surprise us, even though investors seem to have made peace with the idea that country tariffs might not be more than 15%.
What it says is, first of all, it's exhausting. It is a lot of information to deal with, a lot of distractions, a lot of separating of wheat from chaff and signal from noise. That is exhausting for investors. Uncertainty is exhausting. I will say the speed of this lurching that you mentioned, that's meaning that it's simply impossible to time entry or exit into markets. So most investors are just sitting tight and not doing anything. And that is precisely the best thing to do at this time. And simply by staying invested in the markets, they've taken advantage of this nice rise up towards those highs. So I'd say overall, that's a very positive thing that there hasn't been selling out or an attempt to get out because of the volatility. But it is exhausting and it will take its toll, I believe. There's just a jadedness that has come over markets. And volatility is not there yet in the markets themselves, but the uncertainty is what is going to gnaw away at investor sentiment.
Jaded and fatigued. That is what it feels like in this market right now. Even you said that, investors are basically sitting tight here, and maybe that's the playbook. We heard from Michael Hartnett over at Bank of America writing that some investors are taking that a step farther and they're pulling money out of stocks and going into cash. Would you take it that far? Would you take profits here?
This is not the time to be taking profits in our view. We have seen already that participating in equity markets, particularly with the backdrop where inflation is still higher than expected, it is essential to have exposure to growth. And we know from the concentration of markets, it's essential to have exposure to those sectors that are showing the most growth. They really are a law unto themselves at this point, the AI wave, the AI infrastructure wave. Not having exposure to that, I think, will put investors at a real disadvantage. These are not sectors that are moving with macro news around, say, geopolitics or tariffs. So there's a little bit of an insulation effect there. And because all other sectors do seem to be moving with tariffs, particularly the healthcare and the pharmaceutical sector, it's actually good to have a diversified basket of stocks. So simply being in cash today with inflation where it is, not quite as low as we'd like it to be, or being in bonds today, I don't think is a good solution for investors who want to grow their capital over time. Stay invested, but be cautious and do rebalance assiduously.
Well, you make a good point on big tech, and I keep coming back to this Goldman Sachs data that we got this week about earnings growth. It's in big tech. The Magnificent Seven apparently grew earnings by about 26% year over year during the second quarter. You compare that to the remaining 493 in the S&P 500. That number shrinks to just 4%, Aoifinn. So that gulf between the Magnificent Seven and the rest, it just feels to grow wider.
It is, and this is making really the whole complexion of equity markets quite different from what we've seen before. As I mentioned, big tech is really on its own trajectory. It seems completely immune and insulated from the other factors that are eating away at margins, particularly in the old economy stocks, or those very heavily exposed to importing. So I'd say that is really leading to a situation that you cannot be out of these markets. Active managers are struggling because they would find it hard not to be in these large tech stocks. Many of the market caps of these tech stocks, we've seen them rise in excess of 4 trillion in some cases. They're dwarfing the whole economies that are outside the US. So it really has been an essential area to stay exposed to. And I would say it's one law for them and one law for the other 493 that we need to analyze the effect of tariffs and perhaps the sobering effect of a slipping consumer demand on those other 493, because the top 7 or 10 or whatever they may be really is somewhat immune from this.
So even your view when it comes to U.S. equities is to sit tight and not do too much. Does that mean that if you are looking to put money to work, perhaps overseas is a better bet in terms of getting some value for your dollar? Or is it a case where the data that we get next week, CPI, PPI, retail sales, could herald a sea change in the U.S. market and how people view it?
I think you mentioned before the volley of news flow, and that means we're taking our eye off the ball of some of these other stories that are developing. We know the reason that India has been targeted with a high tariff is because it's doing deals on the side with Russia and with other trading counterparties. So this is still happening, even though it's not getting headlines, which means that because of the US trade policy, we are seeing workarounds happen with trading partners, which actually would work to the benefit of some of those trading partners. So we do see a case for investing outside the US. We always have. And just at the beginning of this year, we were speaking about the erosion of US exceptionalism and really a beginning of renewing the fortunes of the non-US markets. So that is still going on behind the scenes. I would say having a broadly diversified portfolio across many sectors, many currencies, is still a prudent long-term position. Although in the near term, American exceptionalism has risen to the fore again, and certainly the muscle is being flexed on the tariff stage, the trade stage. So it is an America first world at the moment. So, and everybody wants to have exposure to US assets, and the gap between foreigners holding US assets and US holders of non-US assets is only growing.
All right, good stuff. Aoifinn Devitt is Chief Global Market Strategist at Moneta. Thank you so much for joining us on this Friday. Have a great weekend. Coming up on the close, a continued discussion on these moves we're seeing in gold, plus the current risks of a market bubble with Paul Krugman, Nobel laureate in economics, and of course, distinguished professor of economics at the City University of New York.
And from an outlook on the markets to an outlook on the box office, we'll discuss the summer movies Hollywood has in store with Paul Dergarabedian. He is senior media analyst over at Comscore.
And the close is ready to take off and jet set into the world of private travel. We're going to sit down and talk demand, pricing, and how you can fly private as well with Jessica Fisher, founder and CEO of Flyjets. All that and more coming up. This is The Close on Bloomberg.
The deprivatization of private equity, it's starting to bother some of the world's top institutions. Growing retail access to private investments is raising concerns among pensions, endowments, and other deep-pocketed investors that, as the pie grows, returns will actually shrink. Let's bring in Bloomberg's Hema Parmar, who covers hedge funds and private equity for us. So the doors are opening to the walled garden. It feels like retail is gaining more and more access to private investments. What are some of the big concerns among those deep pockets?
Yes, these are some of the biggest players in the industry, increasingly concerned about this wave of retail money. They're worried that they might not get as much access to co-invest deals. These are private equity deals that they don't have to pay fees on, and so they're incredibly attractive. They're concerned that private equity firms might be more incentivized to put those deals in fee-paying products from retail investors rather than give them for free to some of these institutions. They're concerned about sharing deal flow with retail investors. They're concerned that PE firms will have so much money to invest that they might impede performance.
Okay, so access is certainly a good thing, but there are a lot of extra questions that access raises, including equal access. What are the broader implications here as you report out this story and more people talk about what this reality would look like?
Right, this is really fascinating because it shows a threatening of the power dynamic that we've seen. Typically, these are investors that hold all the cards, that because of their billions of dollars to invest, that they can negotiate the fees and terms that are most attractive to them. And now we're seeing that a little bit under threat as the attractiveness of trillions of dollars in retail money comes into play. And keep in mind, these retail investors, they represent a lot of cash, but these are individual investors that are generally scattered. They don't coalesce in the same way that a big institution could. So they're less likely to negotiate on fees.
They're not demanding.
They're not demanding. They need to organize and unionize here. So voicing concerns is one thing, but are these institutions actually doing anything about these concerns that they have?
So they're voicing them to the industry body ILPA, which is they're saying that this is the biggest concern that they've been hearing. Some LPs are adding questions to their due diligence as they speak to PE firms. They're asking, what are your future plans to invest in retail? What could this mean for us and the implications for us? Some of them are reducing how much they'll invest in these big firms, bringing down their ticket size to a smaller amount.
What part of this is good news for the institutional investors?
Well, you do have these perpetual, less discriminate buyers, and that could provide some ways to, get some more secondary liquidity into the space where you have seen some difficulty in that side.
It's interesting to read about these concerns from the institution side of things, from the big investor side of things, because the concern has been voiced that, okay, you're creating these products for retail that have private investments. The worry about adverse selection comes into play, that maybe you'll have these issuers basically put in all the bad stuff into the product that goes into retail, which seems to be the opposite of what the institutions are worried about.
Yes, they're worried about what could we typically have gotten and negotiated, and how much could that be at risk? And if we're seeing a lot more cash come into the market, does that mean that these firms may be more indiscriminate in the types of investments they put to work? Could that bring down returns? Could that impede their ability to get these co-invest? Keep in mind, co-invest fees, co-invest opportunities, they bring down the total cost that these big investments firms, these big allocators, typically will consider as private equity fees. So what the typical private equity fees they would have, the co-invest being free, will bring that total amount down, which is why they're so valuable.
All right. Hema Parmar, thank you so much. It's a fascinating story, and it's one that we'll continue to explore all the different angles of. Hema Parmar covers investing and allocations and hedge funds for us here at Bloomberg. And of course, the other big story, especially if you look at the share price, is Fannie Mae and Freddie Mac, government-sponsored entities that are under government conservatorship ever since the financial crisis. The Wall Street Journal now reporting that the Trump administration may finally IPO them.
Yeah, this, of course, has been kind of a white whale for a lot of investors. You saw shares of Fannie and Freddie each rise by more than 20% at one point on Friday. Again, we'll see if this actually happens because it's going to be very hard to pull off. There's a lot of concerns about what this could mean for the mortgage market and as such what it could mean for the housing market as well. But certainly you can see the reaction in shares right now.
Well, it's certainly good news for those who have been lobbying the government to do something about this, including investors who hold stakes in one or the other company, including, say, Bill Ackman.
Bill Ackman having a great Friday, probably.
All right, coming up, Under Armour shares are under pressure, why tariffs are causing sales to sputter. That's coming up next on The Close here on Bloomberg. It's time now for our top calls, a look at some of the big movers on the back of analysts' recommendations. And first up is Trade Desk. Bank of America downgrading the stock to underperform from buy and slashing its price target to $55 from $130 on the heels of the advertising technology company's second quarter results. The firm says Trade Desk's latest outlook makes pre-existing concerns about growth and competition harder to dismiss. The stock plunging 38% on the day.
That is ugly. Let's talk about Zillow, though. Zelman downgrading the stock to neutral from outperform on concerns that Zillow's macro outlook is more subdued than before. The company did acknowledge that Zillow continues to execute well and diversify its end market exposure. Shares down slightly.
And finally, Crocs. Shares of the footwear maker tumbling after it got sliced and diced by 3 different firms. The worst of the downgrades from Sam Poser over at Williams Trading. The analysts also cut Crocs' price target to $80 from $135 after the company reported a third quarter outlook that was well below analyst estimates. Poser says the brand has not been taking an aggressive enough approach. The shares, however, up slightly on the day. And those are some of our top calls.
Let's stay in retail because Under Armour also issued a disappointing outlook this morning, stalling a turnaround plan that was just taking hold. The athleisure company expects tariffs to add around $100 million in costs this fiscal year. And here with more context is Poonam Goyal. She is senior analyst of U.S. retailing with Bloomberg Intelligence. So the CEO of Under Armour, Kevin Plank, he said on a call that none of this is ideal. We don't like this. Poonam, was there anything to like about this report?
I think the one thing to like here is that they're focused on preserving the brand image that they're trying to build. So they don't want to do more discounting. They don't want to sell more into off price. They want to really build the brand. And I think that's really good for the long term. But in the near term, you have to think about an environment where Nike is extremely promotional, right? They're trying to liquidate inventory, and here Under Armour will be near full price. So that will hit sales pretty hard. And we saw that in the guidance for fiscal 2Q, where they're expecting them down mid-teens.
Yeah, and you can see that reflected in shares down about 18% at the moment or so. So, Poonam, it sounds sort of like take your medicine sort of quarter is coming up. When we come back to this earnings report in 3 months' time, what would you want to hear on the call? What does this company need to do in this next quarter?
I think what they need to do is they need to make sure that they can keep inventories low. That's number one, because as they sell full price, it could spiral with more inventory than they'd like to have. And the second on the tariffs, right, $100 million in added costs from the supply chains that are being hit, especially in Vietnam. That's a large amount for them to mitigate. And how are they going about that? Are there more tensions building or not, depending on where the tariff trade wars go from here?
There's a lot of questions, Poonam, as well about demand for Under Armour goods. And we see Nike struggling to clear out its inventory as well and reconnect with customers. Is this an Under Armour specific issue, or is this something that kind of plagues the whole sportswear industry right now?
I don't think it's something that plagues the whole sportswear industry, because if you look at Adidas, right, they're doing really well. If you look at On, they're doing really well. So I don't think it's an issue for the industry. I do think that Nike and Under Armour have brand-specific issues that they're both trying to solve. Nike's moving forward, and as soon as they are able to liquidate the inventory that they have, they should be able to see strength, because we see it in the new product releases. For Under Armour, I do think they need to build their brand equity up, and they are making moves risks to do that. You could also say they're taking the right steps, but it's just the macro is not in favor. The tariff situation is not with them, and it's going to prolong this turnaround and maybe create even some blips along the way.
Right. This turnaround just gets dragged out because it is stalled right now. What else should the turnaround entail moving forward? If it's going to take longer than expected, that's going to bring up new challenges for Kevin Plank and his management team to incorporate as they come out of the ashes here.
Yeah, I think number one, product, right? Product is king here. They need to make sure that they're true to innovation. They need to also make sure that they're not taking price points too up. We heard him talk about on the call that they're taking prices up on the premium product. Now, while that's good in a way because it helps them build that top end of the spectrum, they do need to stay focused on value because as we move through these tariffs in the back half, consumers are looking for that value push, right? And Under Armour, as much as we'd like to say, it's not Nike. It doesn't have that premium brand positioning just yet, so they need to be careful in how they navigate through these price increases across good, better, and best.
Yeah, it's a great point. I guess we will find out how much pricing power Under Armour truly does have. So Poonam, you cover U.S. retailing for Bloomberg Intelligence. We've talked about Under Armour. We've touched on some of the other names, Adidas and Nike. When you take a look at your coverage universe, which company, which team of C-suite executives do you think is doing the best job as positioning their company for this current moment with trade?
Yeah, I'd go to my e-commerce companies here, and I think Amazon, we saw Amazon's results, and they were kind of masked at the retail side by the AWS segment, but retail was very, very strong. And if you think about the company, Amazon, with over $700 billion in GMV, the ability to manage tariffs here was very, very well. I mean, we saw it across 3P sellers and across their 1P. That they didn't have to raise prices. I mean, Andy Jassy said it over and over. We're not raising prices materially. So I think the execution as well there, as well as that Wayfair. Wayfair just reported as well. And really the solid momentum that we're seeing at that company through Castlegate was pretty impressive. And I think the execution is finally showing through that they're able to manage costs and drive growth at the same time.
All right, Poonam, really great to get some of your perspective as we watch Under Armour shares just sink into the close. That is Poonam Goyal. She is senior analyst of U.S. retailing with Bloomberg Intelligence. We do have some breaking news from the Wall Street Journal. President Trump apparently has added a new name to his Fed chair list. That list now includes James Bullard, Mark Summerlin, a former economic advisor to President George W. Bush, Kevin Hassett, and Fed Governor Christopher Waller, and of course, Kevin Warsh. You have to have the Kevins in there.
You have to have the Kevins in there, and I wonder if this leads us to some kind of reality show bake-off, the way that he's done in the past with the Supreme Court justices nominees.
That would certainly be fun and probably good for our industry. Coming up, Nobel Prize winning economist Paul Krugman joins us to discuss the potential warning signs in the U.S. economy. Don't go anywhere. This is The Close on Bloomberg.
All right, we are just about 30 minutes away from the close here in New York. This is the Countdown to the Close. I'm Scarlett Fu.
And I'm Katie Greifeld. We're keeping an eye on the close, but we're also keeping an eye on gold and its non-action right now. We know that a clarification from the White House is coming. Our reporting shows that the Trump administration suggested that it would issue a new policy clarifying that imports of gold bars shouldn't face tariffs. You remember, of course, the news after night really unleashing turmoil in the global gold market.
And you really saw it in gold futures, which really rely on those gold bars for delivery as a hedge against the gold futures prices. We saw gold futures rise as much as 2.3%. That doesn't sound like a big move, but they were basically climbing to record highs, and they've gained tremendously over the last couple of months.
That's the thing. You think about the context of where we are in gold. We were already close to those all-time highs, so 3.2% just adding to that on the futures market. But let's dig deeper into what the turmoil in gold could mean for the broader economy, because joining us now, I'm thrilled to say, we have Nobel Prize winning economist Paul Krugman, distinguished professor of economics at the City University of New York and author of the Substack Krugman Wonks Out. Professor, fantastic to have you with us on this Friday of all Fridays. It's a fluid situation, what exactly the policy on gold imports is coming into the U.S., but I'm curious to hear your thoughts on what it could mean. We talked a little bit about the turmoil. What would it actually mean for the global economy if we did import or put tariffs, rather, on gold imports?
Well, I don't think the economic impact ultimately is very large, but I think what you're seeing is a symptom a lot of us who have been following this stuff have been saying, we used to have pretty simple trade policy. Most countries had most favored nation status, so you had the same tariff for every country pretty much. Customs had a pretty simple job. Now we have different tariffs for everybody, and we don't have the people. We don't have the bureaucracy. And, the federal bureaucracy has been kind of stressed by Elon Musk and all that. So suddenly you're giving them all of these complicated decisions to make, responsibilities, and they're going to make mistakes. They're going to screw up. But it looks like this was just confused messaging. It's as far as we can tell. So I think what we're seeing is, the gold itself is kind of, people pay attention to it. It's symbolic, but it's more what we're seeing is a symptom of trade policy that is too complex for the bureaucracy we have to handle.
That's a really good point, but it's also a reminder that whatever policy the administration does come out with as it makes all these changes, it's subject to change at any given time. As much as they pronounce one thing, there are wrinkles within the policy that emerge later on. What kind of disruption does that cause? Maybe not in terms of the economic numbers, but in terms of behavior by players who are critical to the economy that will only really understand, if not months, years later.
Yeah, I mean, if you're trying to make, real decisions, investment decisions, you want some idea of what policy, trade policy, and other things are going to be. And, what we've been getting now, or what the administration is calling deals, these are not what we call trade agreements. A trade agreement is a signed document that specifies things, often in great detail. Sometimes they're thousands of pages long, and is usually passed by the legislatures of all the countries involved. What we're getting now is understandings that apparently have no paper at all. And now we keep on having stories in which the Trump administration says we have agreed with the European Union, or we have agreed with Japan that they will do such and such. And the Europeans or the Japanese say, actually, no, we didn't agree to that. That's not our interpretation of the conversations. And, that's their problem, except it's business's problem. How are you going to make an investment if if the government itself doesn't know what the trade policy is?
I do want to also get your thoughts on the labor market. Of course, there's a conversation to be had about the Bureau of Labor Statistics. But before we get there, let's just talk about what we learned last Friday with those official non-farm payrolls figures. The number itself for July was weak, but it was really the revisions, Professor, that caught a lot of folks off guard. And there's this fear, this concern out there that actually the U.S. labor market is a lot weaker than numbers had been suggesting on the official level. I was curious how you read them.
Yeah, what we've been seeing for a while is that the soft data, surveys, and just kind of tone and feel, has been weaker than the official numbers. And if we just before we got the ISM survey of services, which suggests basically an economy that's stalling, does not look at all good, and the official numbers have been showing a lot more strength than the soft data have. And what we saw on Friday was the hard data starting to converge on the soft data. So this really does look, Goldman's calling it an economy at stall speed. It is quite concerning.
It is quite concerning, and it puts that much more onus on every data point that comes after that. And eventually, it'll start to raise questions about the data that we do get, depending on who leads the BLS's economic statistics. Professor Krugman, I also want to get a sense from you, this unrelenting rise in the stock market that we're getting, even with all these concerns about the economy and the economic data that is being reported. Tariffs took effect this week, and the reaction from the market, if you look at the S&P 500's performance this week, is kind of a collective shrug. We're set to close out the best week since June. From where you sit, how healthy is the economy, is corporate America's finances? Is it healthy enough to justify the S&P 500's 28% rally and the Nasdaq's 38% rally since April 8th?
Well, I would say, it doesn't look like it to me, but I am not. I have had personally, zero success in predicting stock market movements, which makes me exactly like everybody else. Nobody is any good at this. And the stock market, what we do know for sure is that the stock market is of zero use as a predictor of the economy. Historically, the stock market has given you no indication of what's going to happen. You look and ask, did the stock market, there were a lot of warning signs before the 2008 financial crisis. stock market didn't actually go down until Lehman failed. So I don't think we should make too much of it at all, except to say that, it's Paul Samuelson's old joke that the stock market has predicted 9 of the last 5 recessions. So if you ask me what's happening, I can tell you stories, but the truth is I don't think the stock market is telling us very much at all about the economy.
Right, yeah, and when it comes to the prediction powers, you could say the same thing about the yield curve. Professor, I'm also really curious to hear your thoughts on the Federal Reserve and the horse race that's developing for who is going to replace Jerome Powell. The Wall Street Journal just reported that Trump has added James Bullard and Mark Summerlin to his list of potential candidates. When you think about what is developing, really, this sort of dog and pony show in plain sight, and it seems like the market is coalescing to the idea that we're going to get some pretty hefty rate cuts come next May. What do you make of that?
Well, I mean, I don't know. I don't know Summerlin at all, and Bullard not too well. I've followed Waller quite a lot, and Waller is a solid guy who's made a lot of good calls lately with a good reputation, which means to me that he's not going to be chosen because I think the Trump administration wants a loyalist. And Waller is the kind of guy who might very well decide, my professional reputation matters, and I'm going to take a stand against the White House. Remember, Trump chose Jerome Powell, and now trashes him constantly, and he probably doesn't want to find himself in that situation again. So my money is on somebody who actually is. It looks weak enough that he'll essentially be their guy rather than just a good Fed chair.
So there is going to be a bit of a dog and pony show for each candidate to then prove just how pliable they might be.
Yeah, I mean, there was one Substack post by somebody else that I did like. I'm sorry, but I envy the title, and it was actually about Kevin Haspert. It was called "The Banality of Weasel." Everything we've seen in other appointments is that this administration values loyalty above all else, and I don't think they get that from the stronger names on that list.
All right, Paul Krugman, thank you so much, telling it like it is from his point of view. Nobel Prize-winning economist and distinguished professor of economics at the City University of New York. Coming up on the close, no beef from Wendy's investors as that stock heats up after earnings. It's today's Stock of the Hour next. This is The Close. All right, shares of Wendy's hang on to a gain after a mixed earnings report. Investors seem to forgive Wendy's revenue miss and disappointing full-year outlook. Michael Halen is senior research analyst at Bloomberg Intelligence, and he joins us now. Michael, are you puzzled by the positive reaction despite this sales miss and a worse-than-expected outlook?
Well, what I think we need to keep into perspective is this stock was down by more than 50% since November heading into this print. We used to joke around on the trading desk, stocks don't go straight to zero. So, I don't think there's too much bullishness here. I think if anything, maybe investors might have kind of liked what the interim CEO had to say about kind of pulling back a little bit on promotions and improving the operations, which we think is the right path. Executing those is not going to be easy.
Yeah, so you can see Wendy's shares, a little bit of a pop today, but down 36% on a total return basis year to date. That is a tough look. But Michael, I mean, when we've gone through this earnings season, the conversation has really been about tariffs, the impact of trade policy, how the consumer is feeling. When you zoom out and you look at your coverage universe, what is the state of the consumer that's going out and spending their dollars on food, on restaurants? How does that actually look?
Look, there's no question that low-income consumers are under pressure, and that's because of inflation. It's cumulative, right? And so they're impacted the most, and they continue to pull back on their restaurant spending. That being said, 2025 is better than 2024, and it's been improving throughout the year, and we think it's going to improve again in the second half. Last year, we had our restaurant recession. Consumers pulled back big time across the income spectrums, right? There was a little bit of pent-up demand this year. It got off to a tough start this year because of weather, cold weather, snow, a bad flu season, right? But everybody was running around with their hair on fire over tariffs, and restaurant spending hasn't really skipped a beat. And so, as this year rolls on, solid results keep coming in. That being said, people are more discerning. And so they're spending money where they know they're going to get a good experience, good value, good service, right? And so what we're seeing in our market is a bigger widening gap between winners and losers.
Right, and perhaps one of the losers, at least for today, is shares of Sweetgreen, slashing its sales guidance, second straight quarter of disappointing sales. I know you don't cover that company specifically, but in terms of what that indicates about consumer demand, is this a Sweetgreen specific story where it can't get the pricing and the product mix right?
Yeah, 100%. Because, you look at this week, we had McDonald's absolutely crush it, right? Domino's crushed it. Both of those chains have been doing a better job getting low-income consumers in their doors, right? Texas Roadhouse put up another great number, right? So if you're providing your consumers with good value, good service, they're going to come, and they're going to come frequently.
All right, Michael, great to check in with you. That is Michael Halen. He is senior restaurant analyst over at Bloomberg Intelligence.
When was the last time you paid for a $20 salad from Sweetgreen?
Like 2 days ago. Criminal. Didn't feel good. Coming up, Steve Sosnick joins us. He is chief strategist over at Interactive Brokers. This is The Close.
We have had a non-stop volley of news, and basically it's very hard to have any time to digest any of this, particularly in what is typically a slow summer month. So I'd say this is exactly the issue we're having with tariffs. We don't know what the transmission effect is going to be. Nobody does. It has seemed to have been less impactful initially than was originally thought. Now we think it may actually be more of a latent transmission effect because many firms have taken precautions to actually take some of their costs up front.
That was Aoifinn Devitt, Chief Global Market Strategist at Moneta, kicking off the show. She talks about this latent transmission effect. So until it shows up in the numbers, in earnings, in profit margins, investors will continue to bid shares, well, for the Mag 7 higher, but maybe sometimes the other 493 stocks higher as well.
That seems to be what's happening right now. You take stock of where we are just 10 minutes away from those closing bells. The S&P 500 actually going to end this week on a high note, higher by about 0.7%. It's that strength in big tech that's fueling things. The Nasdaq 100 up about 0.9%. The bond market selling off a little bit. We're still below 430 on that 10-year yield. Gold, we have this up because this is theoretically where the action is. You don't know it by just looking at the spot price. Futures market, it gets a little bit more interesting, but a lot of back and forth on where the U.S. stands on actually putting tariffs on gold imports.
It's kind of the ongoing debate and the latest example of what we're debating and discussing here. So for more market analysis, let's bring in Steve Sosnick, Chief Strategist over at Interactive Brokers. And Steve, what were your thoughts this morning when you saw the news on gold and the price action in gold where futures jumped to a record high because of this question over whether we're going to start putting tariffs on gold imports from Switzerland?
Well, I kind of got awoken to like various messages from our Hong Kong team going, what's going on here? You know, is it 1 kilogram? But what about like the mini contracts, which are 32 ounces? It's all different, and no one knew what was going on, and that's part of the problem. I'm not going to win a Nobel Prize for echoing Paul Krugman, but basically,
hey, you don't know that.
Maybe not, but that epitomizes again the mystery that goes on here, and why the relationship between the spot price of a commodity and the futures price of a commodity tends to be relatively stable, and the relationships between the deliverables in various parts of the world tend to be relatively stable because it's transportation or whatever. This completely caught everybody by surprise and threw everything off because you didn't even really know within the U.S. what the deliverability was going to be on terms of the tariffs. It's a very difficult way to go through life.
Yet the stock market kind of took it all in stride, as has been taking most of the tariffs in stride, 15% being the new 10%. Even the threats of new tariffs on certain sectors don't seem to be causing much more than a ripple for equity investors. What is your read on that? I mean, is it just a case of people are fatigued by headlines and they figure, I'll wait until I see it in the numbers?
It is very much wait and see. I wrote a piece earlier this week pretty much yesterday, I think, declaring the death of the taco trade. Because
Trump always chickens out.
Trump always chickens out because he didn't chicken out. He put them in and the market didn't care anyway. So therefore, that was a red herring. But what's going on now is the market it's so self-referential. It's about momentum. I've been saying this over and over, MOMO and FOMO. It's momentum and it's fear of missing out. And it's become very short-term oriented, so it matters more if you're getting some short-term trading momentum than the longer-term stuff that you were just referring to about, how is this going to affect earnings? Since nobody knows, let's just keep buying it because everybody else is.
So there's definitely fatigue on investors' part when it comes to tariffs and the different headlines we get. But you think about the effective tariff rate, it's between 15, 17%. It's much higher than where we were a year ago, perhaps even 6 months ago. I mean, when do traders start to care? When does that start to show up in a way that's meaningful for markets?
I think it does matter. I would have thought it would have been this earnings season, but there was so little clarity that it didn't show up because nobody could really announce for it. So in theory, next quarter's earnings, because that's really going to have to, at some point, they're going to have to acknowledge what's going on. First quarter, in the April earnings, basically we let companies punt. I don't know,
Sure, let's go with this.
I know what my guidance is, and they didn't really get punished for it, partly because the market had been so beaten up. This quarter, they had to say something, but they didn't really address it in so many ways. And so let's see what happens, the September earnings season. I hate to kick this out 3 months because we're just finishing up this one.
Yeah.
But what happens then as we start to, go through those earnings? I guess it would be October, sorry.
Well, if you think ahead, who knows what will happen between now and then. But what do you think that the expectation from investors will be? Okay, everyone got a pass in April. Who knew at that point what the numbers would look like? This time around, it seems like investors want to see something. It's the companies that are basically not putting up any numbers that are getting punished here. What do you think the reception will be like in the next earnings season?
It depends if expectations change between now and then. If we keep them fixed without any real way of addressing them, and then you get negative surprises, look out below. If it's a matter of an adjustment process that analysts will be on top of it and companies will adapt their guidance to it, then you can, we work it through the system, and maybe we don't race ahead necessarily every company every single day, but we adjust for that and we blend it in. So it's really a lot of times how much of a shock it will be to the system.
How are you thinking about treasuries, the fixed income side? We've seen yields rise pretty much all this week, and we had some auctions, 3, 10, and 30-year auctions that didn't go off great. And again, yields rising, but off this base of below 4.2% for the 10-year.
I think they went, the market didn't react that negatively. I guess it was a big, technically, if you're a treasury trader, it was a big spreads between the 30-year when issued and the auction rate, and that's not a good sign. But ultimately, they didn't get punished too much. I still do wonder. I still think one of the scarier trades out there is the steepening of the yield curve. And that's one of the ones that I'm actually surprised we haven't seen to greater effect because, historically, we're still at a very, very flat yield curve. We're talking about now the potential for lower rates. Depending on how the how the Fed selection goes, we might be more aggressively cutting rates than anticipated. And if that's the case, that might actually skew inflation expectations higher. So that to me is sort of the trade that worries me the most because it seems one-sided. It's hard to imagine that we get a much more of a flatter yield curve, but I can come up with a lot of scenarios that'll give us a much steeper yield curve.
All right, let's leave it there. Steve, always a pleasure speaking with you. Steve Sosnick is Chief Strategist at Interactive Brokers. And Katie, for a market that wasn't able to string together 2 days of gains, this week, we are going to close pretty much at record highs.
Yeah, it looks pretty good. You take a look at the S&P 500's performance this week, up 2.4%. Like you said, it was a really staccato week. We had down days, we had up days. It looks like this day, unless something amazing happens in the next 2.5 minutes, we're looking at pretty strong gains across the board. Breath looks pretty good right now.
Yeah, 20 out of 24 of the industry groups in the S&P 500, or I should say 19 out of 24, finished higher with tech as a group. Tech hardware up 11.3% for the week.
There you have it.
So I think that tells the whole story of what's going on in this market. Big tech leads the way again. All right, we're moving closer to the closing bell on this Friday. We've got full market coverage right here on Bloomberg Television and Bloomberg Radio. Keep it right here. This is Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
We're about 2 minutes away from the end of this trading day. Scarlett Fu and Katie Greifeld here to take you through the closing bell. We've got a global simulcast, so let's bring in our friends in radio, Carol Masser and Jess Menton, who is in for Tim Stenovic. So it's ladies this Friday evening, bringing together the best of our Bloomberg Television and Bloomberg Radio talent and our YouTube audiences. We want to welcome you worldwide to parse through the most crucial moments of the trading day. I feel like the most crucial moment, Carol, came before the U.S. market opened when we're trying to figure out what is going on with gold imports. imports.
I know. I gotta say, if you missed, I'm sure you guys did this really well. We had Joe Doe explaining it, really turmoil in the gold markets, and then the White House coming to kind of clarify that, well, maybe we're not doing this in terms of tariffs. So it's been kind of crazy. Joe Doe, though, making the point that we've seen the copper market and the gold market really disrupted for moments in time, and that's not a great kind of market environment to be within. And so you kind of wonder what might come next.
I mean, now that it's Friday, though, looking at major indexes and the S&P 500, NASDAQ 100 on pace for their best week since late June, guys.
Yeah, which is kind of surprising. Scarlett and I were just talking about how sentiment was really staccato this week. You had 2 down days that felt pretty bad, and then you had 3 up days. You add it all together, like you said, Jess. I mean, it was a pretty good week in totality, but definitely some dicey moments along the way.
And just a week ago, we were still dealing with the jobs report that indicated things are a lot worse than what we had thought. So this idea that everything's great again is kind of a surprise. I mean, certainly if you look at the price action, you concluded that it might make sense given that we're at record highs, but there's still a lot of questions remaining over the economy and now the sanctity of the data that drives that economy. All right, let's take a look at where things are as we hear the closing bells on this Friday. We're looking at highs here, closing right around the highs here for the NASDAQ, certainly up 1% on the day. That is the NASDAQ Composite Index. The S&P 500 adding 0.8% as well, and the Dow Industrials gaining about 0.5%. The laggard of the bunch here, Carol, is the Russell 2000 advancing by 0.2%.
Yeah, that's kind of interesting to see that underperformance there. Hey, S&P 500, guys, I'm going to go back to the big cap index. And Katie, you've got kind of an even split, but a little bit more names to the upside. 295 gaining ground on this Friday, 204 to the downside, 4 unchanged.
Yeah, it's a similar story when you take a look at this big circle of sectors right here. Your outperformer was tech, but you can see there's a lot of green on this screen right now. Tech, communication services, healthcare, et cetera. The list goes on. If you're looking for some weakness, you're going to find it in utilities. You're going to find it in real estate. But overall, pretty good day.
Yeah, absolutely. I had a lot to choose from in terms of individual gainers, but I had to do Fannie Mae and Freddie Mac. Fannie Mae up just shy of 19% in today's session. Freddie Mac up almost 21% today, jumping initially after a Wall Street Journal report said the Trump administration is getting ready to sell stock in the 2 enterprises later this year. Bloomberg News confirming that as well. Fannie and Freddie right now trade over the counter. They're accustomed to volatile swings, and we definitely saw some big swings, certainly in today's session. All right. Also, Gilead Sciences, another outperformer. In fact, it's the #1 gainer in the S&P 500 and the NASDAQ 100 today. That stock up more than 8%, the highest in 10 years after boosting guidance. The company lifted its full-year outlook after strong HIV drug sales in the second quarter, helping revenue and earnings modestly beat analyst expectations. And the drug maker also raising its guidance for annual product sales by about $100 million. So this is a company that's been looking to expand beyond its core HIV drug portfolio into cancer and other therapeutic areas, and they've had some mixed success, but nonetheless investors liking that latest update. And then Monster Beverage, this one, second best name in the NASDAQ 100, 4th biggest gainer in the S&P 500, up about 6.5%. The company reported earnings and sales for the second quarter that beat the average analyst estimate, and analysts noting strong global momentum in the month of July. Piper Sandler upgraded the stock to overweight, raised its price target. Morgan Stanley also raising its price target, so definitely some outperformance there. Jess, over to you.
I'm going to start off with the worst performer in the S&P 500 today. Trade Desk, the ticker TTD on this, down 39%. Its worst day since September 2016. So you have so many different analysts on the sell side that have been bailing on the one-time market favorite. What happened here? Growing fears that its advertising technology will get steamrolled by none other than Amazon. Another company, of course, I'm going to point out, Sweetgreen, ticker is SG on this, down 23%. This was its worst day since November of 2021. Unfortunately, the salad chain cut its sales guidance and it also missed second quarter estimates there. So now analysts are saying that 2025 is turning into a disappointing year. That stock's down over 70% year to date. And then lastly, looking at Under Armour, UAA is the ticker symbol, down 18% today. So it's the worst day actually since April 3rd. So when you're thinking about apparel and footwear maker here, its Q2 forecast ended up coming in horrendous. And of course, that was weakness in North America. So it forecasted adjusted EPS and revenue that fell short of those consensus expectations, guys.
All right, let's go over to the bond market. You had treasuries falling across the curve, pushing yields higher anywhere from 2 to 3 basis points. And really, there wasn't any clear catalyst. There was some anticipation, of course, of the July CPI data next week, as well as PPI, that could alter expectations for Fed rate cuts. Perhaps some people also saying that the declines reflect overhang from the coupon auctions that we saw this week. $125 billion worth of new supply. There's also a lot of supply of new corporate credit as well.
All right, guys, it's been a pretty heavy week. We ain't over yet, and we might get more from the White House. We're monitoring certainly some of the meetings that are going on there with foreign officials. Having said that, we got a few lighter stories that we wanted to bring to you and share with you on this Friday. Just mentioned the drop in Sweetgreen shares today, and we did see that stock really take a hit. They're apparently discontinuing. I had no idea that they were offering French fries at all, but they're discontinuing their Ripple fries.
Healthy fries.
Fries you can feel good about.
Healthy fries? I would rather just have the greasy good stuff for
avocado oil. I mean, if you're going to have French fries, why not just go for it, right?
That's the thing. I feel like it was mission creep on the part of Sweetgreen. We did hear from the CEO on a call with analysts saying that basically customers like the fries. That's what he says. But they added too much complexity to restaurant operations. So they're
also not enough people ordered it, so they would make the fries, then they would sit there for a while, and then when you actually did order the fries, you'd get the fries that had been sitting out for a while. They were air fried, and they used avocado oil instead of seed oils, which I don't know about you, but I like my fries crispy. I don't want them soggy and sitting around.
I love McDonald's fries. I'm just
those are
going
the
to tell
best
you,
ones.
they're like killer fries.
Yes, 100%.
I also like
Hands down.
Popeye's fries. It's they have the Cajun seasoning.
All right, we got to go to another chat, guys. I don't know. Who's going to take this? Come on.
Go for it. You're a mom of a college daughter, right?
All right. So, yes, I do have a college daughter. And yes, we're going to have a conversation when we come home. But apparently, college kids are scheduling everything on Google Calendar, including walks to class, dates, come on over to my dorm.
I can't.
Wait, come over to my dorm?
I guess so. Was one, they talk about this freshman, early in her freshman year at Cornell, Vanessa Long got a Google Calendar invite from a classmate. Come over to my dorm for the invitation scheduled for 10 p.m.
What, in 5 minutes?
It's really type A.
I don't know.
It depends on, what you're in the market for. It's like a you up text, except it's a GCal invite. I love this quote from a senior at Georgetown University, Caitlin Martin, saying that it's a relief to just go where GCal tells her, I don't have to remember things, she added. To which I would say, Caitlin, just forget things. It's okay. We don't have to map out our entire day.
That's what my team says. Don't you even look at your calendar? I'm like, no, unless you talk to me, it ain't going to happen. But it's just very different, right? This generation.
Gen Z is very scheduled. That's the way they grew up. But, just have them come work in the markets and everything will blow up because you can't plan anything.
It is
headlines will come from out of nowhere.
It is funny. I feel like you're seeing some of this when it comes to how companies are trying to navigate the shifting tastes of the different generations. We know that apparently, Gen Z dates differently. You can see that in some of the dating apps struggling. Apparently, they don't drink as much. That's why you're seeing some of these big beverage companies sort of re-navigate how they're approaching low alcohol and zero alcohol products. It's just a different game.
They're busy updating their GCals.
Yeah, they don't have time.
Do you think it's too late for me to put an appointment or ask you guys that maybe we can go get some Ripple fries? Is that too soon?
You got to do it right away because they're going to discontinue them immediately.
Yeah.
All right, guys. It's been a busy week, a busy day. Have a good and safe weekend. That is a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals, both of us on the TV side, certainly on our side, monitoring some of those meetings out of Washington. We'll take you there. And if there's any conversations maybe with the members of the press community. All right, guys, that is a wrap. We'll see you again, same time, same place on Monday.
Coming up on The Close, a continued conversation on the White House's back and forth gold tariffs with Bart Melek. He is head of commodity strategy over at TD Securities. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu. Let's show you what happened in equity markets today. You had the S&P 500 failing to string together 2 days of gains this week, yet it did make its way back to a record high during the session and closed just below that record high by the end of trading today. The Nasdaq 100, however, did close at an all-time high, gaining almost 1%. We are seeing yields rising here after $125 billion of debt sales this week. It generated a lot of new supply in the market. There's also a lot of anticipation before next week's CPI, PPI, and retail sales reports next week. We'll give you a preview later in this hour. And spot gold unchanged at the moment, but it has been up and down all day on a lot of confusion over the surprise imposition of tariffs on certain gold bars, and then reports from Bloomberg and others that the White House will clarify what it calls misinformation on those gold bar tariffs. So we will keep you posted on those developments. In the meantime, let's take a look at some of the day's big movers. We're going to start with Under Armour, finishing the day lower by 17%. The brand's turnaround plan seems to be stalling after it gave a disappointing sales and profit forecast for this quarter. Under Armour saying tariffs will add about $100 million in costs this year. Fannie Mae and Freddie Mac jumping by double-digit percentages, rising the most in more than 2 months. Bloomberg learning that the White House may sell between 5 to 15% of equity in these two companies. The IPO is expected to raise about $30 billion. Of course, these are the government-sponsored entities that buy conforming U.S. mortgages from lenders and then repackage that debt into mortgage-backed securities. The government had bailed them out right around the great financial crisis, and they have been in conservatorship ever since. All right, let's go back to the equity market for this week because 19 out of the 24 sectors finished higher. And we want to kick things off with Chris Cain of Bloomberg Intelligence for the latest edition of Factor Friday. And Chris, you look at the usual factors, whether it's momentum, whether it's value, but you also wrote about the shareholder yield factor, which is a new one. What is this and how's it performed?
Yeah, Scarlett, this is something that I think is very interesting, maybe not as well known. So let's start with dividends, first of all. So dividend yield is a factor. I think everyone understands that. Everyone loves dividend yields. Yep. They love getting payments on their stocks. But to me, dividend yields, really leaves a lot to be desired. Number one, as you know, a company can pay, capital to shareholders in many ways. It could do it directly through a dividend yield, or it could do it indirectly through a share buyback or even debt reduction. So that's what shareholder yield does. It's a more holistic way to measure capital return to shareholders. It includes those indirect as well as their direct ways. I think it makes a lot more sense. Empirically, it's performed a lot better. I mean, even if you look at the high shareholder yield group versus the high dividend yield group within the S&P 500, that shareholder yield portfolio is over 5% higher, outperformance this year, over double the cumulative return over the last 10 years. So it's worked a lot better, and I think it's a more logical factor. Okay, it's a more logical factor, but as you mentioned, it's more holistic. It includes more, including the buybacks. But how does it compare performance-wise from a factor perspective to the high dividend yield stocks? Yeah, one of the things that you always look at when you look at factors is like, what other factor is this factor like? You have a portfolio and you could say, is it high momentum or low? Is it cheap or expensive? Is it high vol, low vol? So dividend yield factor versus shareholder yield factor, I would say both of them are value-like factors, right? I would put that under that broad category. But that's kind of where the similarities change. So when you look at dividend yield, it's value-like, but it's explicitly anti-growth and anti-profitability. It shows much lower loadings on those factors, where shareholder yield is not. So to kind of sum it up, they're both value-like factors, but the shareholder yield doesn't sacrifice the growth and the profitability like dividend yield does. Okay, what about size? And I even wonder whether this is a factor because everything is size by default. I wonder what the valuation differences are between big and small cap stocks specifically, because there's a lot of concern that the big cap stocks, specifically 7 companies, are overvalued and at this point nearing bubble territory. Yeah, Scarlett, I mean, you're calling it a question. I think most quants are calling it into question. So just as a little history lesson, it's the small size factor, right? That's supposed to be a premium for smaller size stocks. You could do this like small caps versus large caps, or you could do it within large caps, right? So the smallest large caps versus the largest large caps. To say something very obvious that hasn't worked this year, that hasn't worked in several years, it calls into the question, is small really a real factor, or does it have a real risk premium associated with it? That's a bit of a bigger discussion, but it hasn't worked very well, and the result of that underperformance for years is a very dramatic valuation difference. So looking at price to sales, large companies over 4 times, small companies under 2 times.
Wow.
It's the highest spread, literally the 100th percentile in over 25 years. So small companies within the large cap index are some of the cheapest relative that they've ever been to large.
Okay, so that's opportunity for someone, certainly. Chris Cain, thank you so much. Chris Cain of Bloomberg Intelligence with our Factor Friday. Let's shift gears and now look at gold, because it's been a bit of a roller coaster ride here for gold. Bloomberg learning that the White House will issue a new policy clarifying gold bar imports should not face tariffs. The order could calm a market that was rocked by the prospect of a tariff on gold imports. Joining us now to discuss is Bart Melek, head of commodity strategy at TD Securities. Bart, how's your day today? How did it go?
Well, it's been a little erratic, and things were quite volatile all around.
Quite volatile all around. Can you tell us a little bit about the significance of the 1 kilo and the 100-ounce gold bars? Because those were the products in question that President Trump's tariffs would have applied to. Why are those bars significant?
Sure. Those are the bars that you typically, you always use to deliver against COMEX CME contracts. Typically, bullion banks will bring those over and use them to deliver against contracts. And they are very different than the LBMA 400-ounce bars. There are 100-ounce or 1 kilo bars. And the market was assuming that they would be exempt from any tariffs. There was a review by some legal experts on behalf of a refiner, and the conclusion was that, in fact, the definition, according to the customs officials, that they would be tariffed, and that precipitated a large increase in the spread, or the difference between the London price and then the New York price, if you will, reaching as much as over $120. You go back at the end of the day, and we are pretty much where we were before this hit the news.
Okay, so people describe the global trade flow of gold as triangular. These large gold bars traveling between London and New York, but they make their way through Switzerland. Talk about the role that Switzerland plays and what tariffing those gold bars out of Switzerland would have meant for your business, for what you do day in and day out.
Well, sure. The issue is that LBMA bars or Bank of England bars do not qualify as so-called good delivery bars on the CME, meaning that before you can bring them over to New York and use them as, to deliver against a short EFP position or something like that, you would have to make them in a format that's so-called good delivery. That usually would have you take a 400-ounce bar from inventory in the vault in the LBMA system, move it to Switzerland, melt it, and move it into the form that is good delivery, that is acceptable for the U.S. contracts. So essentially, it would go London, Switzerland, and then back here.
Right.
Of course, it's not only Swiss bars. Something like RCM, Royal Canadian Mint, and Mexican product are also good delivery bars.
Bart, head of commodity strategy over at TD Securities, thank you so much. We got to leave it there because we want to take you to the White House right now where President Trump is speaking. Let's listen in.
I don't like using the term last chance. Look, it's, look, this is two very, very smart people. They've been going at it and their predecessors also very smart. They've been going at it for 35 years. It's tough. And, when those guns start going off, it's awfully tough to get them to stop. It really does. It's a war that should have never happened. It would have never happened if I were president. There was no reason for it. So many people are killed, so much cultural destruction. You look at those magnificent towers, the most beautiful in the world. The spires were considered the most beautiful in the world. They're all in 1 million pieces, laying on the ground, all obliterated, knocked into 1 million pieces. So sad. But millions of people have died, and very, very much set in their ways. A lot of people were set in their ways, but I think we're getting close. I mean, this was not my war. This was Biden's war. But the European Union has been great. As you know, they're purchasing equipment from us. They have a lot of money. and they're spending a lot of money on buying equipment. We're not spending money, but we are supplying them equipment. They're paying for it. And I think, I think that a lot of things happened recently that would make this go forward. I'm not going to mention anything having to do with India, but maybe that had an impact. But what really had an impact was NATO has stepped up in terms of their spending on buying military equipment. We're in for, probably through Biden and his people, $350 billion. $350 billion. When they hear these numbers, you're saying that's a lot of money. $350 billion the United States has spent on that. It should have spent nothing because it should have never happened. It would have never happened. And Europe is in for over $100 billion, which is, it should be the opposite if we were in for anything, but it should be the opposite. And I will say that Europe wants to see peace. The European leaders want to see peace. President Putin, I believe, wants to see peace, and Zelensky wants to see peace. Now, President Zelensky has to get all of his everything he needs because he's going to have to get ready to sign something, and I think he is working hard to get that done.
Will Zelensky have to give up territory, Mr. President?
Well, you're looking at territory that's been fought over for 3.5 years with, a lot of Russians have died, a lot of Ukrainians have died. So we're looking at that, but we're actually looking to get some back and some swapping. It's complicated. It's actually nothing easy. It's very complicated, but we're going to get some back. We're going to get some switched. There'll be some swapping of territories to the betterment of both. And but we'll be talking about that either later or tomorrow or whatever. Yeah, please. Say it.
If I could ask a question of your guests and also of you.
Yeah.
Of the guests, will the Armenians from Nagorno-Karabakh be allowed to return? And also, do you have any thoughts on the talk about President Trump winning the Nobel Peace Prize? And for President Trump, you're working on resolving 2 other major conflicts. In Gaza, you've spoke of resettling the Gazans. The country of Somaliland has expressed potential interest if you were to diplomatically recognize their independence. Are you inclined to do so? And also, did President Putin present an award to Mr. Witkoff during their recent visit?
He likes Mr. Witkoff, I can tell you that. That's true. Please, go ahead.
I think President Trump deserved to have a Nobel Peace Prize, and we will defend that, and we will promote for that, and that's obvious. So, and today's event, I think, is a very bright expression of that, and hopefully you will invite us. To
front row, you'll be front row.
Yeah, yeah. We are in favor.
Thank you. Thank you.
Can I have a suggestion?
Yes.
So maybe we agree with Prime Minister Pashinyan to send a joint appeal to Nobel Committee to award President Trump with the Nobel Peace Prize because from the leaders of the countries which were at war for more than 3 decades, having this historic signature here, it really means a lot. This is tangible result of President Trump's leadership, and no one could have achieved that. There have been many presidents here since beginning of 90s, and the so-called Minsk process, which, by the way, today we put an end to with my Armenian colleague, started in 1992. So negotiation under the auspices of OSCE continued for more than 3 decades without any result. So who, if not President Trump, deserves the Nobel Peace Prize? I don't want to go into the history of some very strange decisions of the Nobel Peace Committee to award the prize for someone who didn't do anything at all. But President Trump, in 6 months, did miracle. So I think that my Armenian colleague will support it, and judging by the reaction of the audience, I think as soon as we come back, we will agree to issue a joint letter And hopefully, and I also join when President is awarded, we hope that he will invite us to the ceremony.
You certainly will be. Thank you very much.
Do we have draft to sign now?
Well, we'll see what happens.
We already like to sign.
Thank you very much. It's very nice. We're looking into that right now. Good question, actually, and another complex one, as you know, but we're working on that right now. Somaliland.
Thank you so much. I wanted to ask you, have you spoken to Russian President Putin yet? And would you go to Russia or Ukraine? And what exactly would you say to him?
We'll be announcing a location in maybe a little while, and I think you'll be very happy. We'll see what happens, right? All we can do is do our best. We've been working on this one for a long time. This is a very complicated one also. This was extremely complicated, but we made it less complicated, and we had two very brilliant people on my right and my left. They understood what was at stake. I think if it didn't get done now, it might have never gotten done. So this is the same, very similar with Ukraine. It became more and more complicated as time went on. It was simple at the beginning. It wasn't going to happen, but it became more and more complicated. But I think we're getting close. Yes, ma'am. Yes, go ahead, please.
Could the location for the summit be Italy?
Oh, I will give it to you very soon. Honestly, I don't want to do anything. These guys, I don't want to do anything where that's like, because this is a bigger story than a location. A location's good. I'm a real estate person. I know about a location. But there's nothing to compete with this in terms of what we're doing today. It's just such a great achievement for these two. Really, they'll go down as great leaders for what they did. I put them together, but what they have been able, and I don't want to do anything. So we'll talk about it later. Today, we'll give you a location today.
You were talking about sending military forces to fight against the drug
that was
cartels.
the president speaking at the White House right now, making some comments about a summit with President Vladimir Putin of Russia. We will bring you back to his comments if he does say anything more, especially as it concerns the economy or tariffs or the markets. Now, meantime, the president's search for the new Fed chair has expanded. This is according to the Wall Street Journal. You now have St. Louis Fed President James Bullard and Mark Summerlin, a former advisor to President George W. Bush, reportedly under consideration. Bloomberg's Ed Harrison writes about this and other macro concerns in the market, and let's bring him in right now for a little more context. So, Ed, is it surprising here that the pool of candidates has widened? I was a little bit surprised that someone who worked for President George W. Bush might be under consideration.
You know, it isn't that surprising because Scott Bessent is taking over in terms of helping to look for the new Fed chair. The fact that he's not in consideration, he said he wasn't in consideration, shows you that he's now sort of running the process or being heavily involved in the process. And he's very concerned as a markets person that the markets look positively on whoever is in contention. So we have what I would consider relatively conventional picks, along with Christopher Waller, who's a governor at the Fed right now.
Right. Okay, that's a good point. It shows not the nod to markets, but the acknowledgement that markets are paying close attention to all of this from someone who is obviously mindful of the way it'd be received. Ed, you also write about the concerns over stagflation, in particular following the weaker than expected jobs report we got last week. It seems like those concerns are out the window, at least for this week, but there is data that concerns you. And you look at, for instance, the soft data like ISM services that perhaps don't tell a great story about the U.S. economy.
Yeah, that particular piece of data was very interesting in that when you looked at the overall number, which was almost at recession levels, but then you looked at the inflation number, which was at 70, which would translate into a 6% CPI in the next 2 or 3 months if you pass on all of the tariff increases. That's where the Fed is now. That's what they're having to contend with. They're having to contend with very high price pressures in the pipeline from the ISM services. And then at the same time, we saw with the jobs report and again with ISM that the employment data are not as good underneath the surface as the the headlines would lead you to believe.
All right, good stuff. Edward Harrison, writing for Bloomberg. He has the Everything Matters newsletter that he writes here for us. And we will, of course, keep you up to date on further developments when it comes to headlines regarding the central bank head. Now, let's get a check on gold yields and the dollar. Top of mind, certainly, for investors in this tectonic week on the economic news front. From this morning's shock upheaval in the gold market to President Trump choosing Council of Economic Advisors Chairman Stephen Myron to fill a newly vacant seat on the Federal Reserve Board. Let's cut through the noise right now with Greg Valliere. He is Chief U.S. Policy Strategist at AGF Investments. Greg, there's a lot to go through right now, so I'd like to start with this idea that the president is starting to fill in the pieces here for the Federal Reserve Board. We talked about just now with Ed Harrison about how the pool of potential Fed chairs has now been widened to include James Bullard, the St. Louis Fed president, as well as someone who was the economic advisors to President George W. Bush. Do you see this as a process that's going to unfold over several months and will be reactive to the markets as well? There's going to be this dynamic that depends on how the market reacts.
Yeah, no, I don't think it'll be several months or even maybe not even several weeks. I think once we get through the Jackson Hole meeting later this month, and then we focus on the next FOMC meeting in September, I think things will start to clarify. To me, the most intriguing angle is that more and more people are talking about 50 basis points in the September meeting, not 25. And I have been told that if it's only 25, Trump would not be happy. I think Trump is putting out the word that we're way, way behind the curve. If we get another clunker of a number like we had a couple of weeks ago, I think 50 is really in play.
Okay, that's a good thing to keep in mind here, especially as the FOMC gets ready to meet in September, because in August, like you said, we have the Jackson Hole Symposium sponsored by the Fed. Greg, as you look at what investors are contending with, whether it's monetary policy from the Federal Reserve or the economic data that we're getting that the Fed, of course, uses to evaluate its next move, what is your sense of how this search for a new economic statistics head at the Bureau of Labor Statistics is going to play out? Because obviously the president has made clear he chooses people that he finds are loyal to him. And the economy, the investors are relying on data that is objective, that is without question reflects what's actually happening. And there are now big questions about whether we can rely on that going forward.
You make a good point. I think loyalty to Trump is key. Bullard is intriguing, but Bullard has shown during his career that his greatest loyalty is to Bullard. I think that Chris Waller, is a very intriguing pick. He's, I think, very inclined to cut rates. He's well liked. I think he's the sleeper in this whole mix.
The sleeper in the whole mix. All right, it's something that we'll watch for. Very quickly here, Greg, what is your response to how this whole gold tariff played out? It seems like there's a lot of confusion, especially with Bloomberg reporting that the White House will soon issue a clarification on tariffs on gold bars from Switzerland. But at least initially, the Trump administration came up with this ruling that, yes, there will be tariffs on certain gold bars.
Yeah, I think there's sort of a misperception that the tariff wars are over. You know, try telling that to India, try telling that to all my friends in Toronto and Canada, which seemingly has been left out. There are still lots of countries that haven't gotten their story resolved, including Switzerland, which had an enormous tariff put on its products. So we're looking at months and months before we get all of the deals done.
All right, Greg Valliere, really appreciate it. Chief U.S. Policy Strategist over at AGF Investments. And all of this is happening as we brace for a wave of economic data next week. We get market moving numbers, including July CPI on Tuesday and PPI, that's wholesale inflation, on Thursday. Retail sales and manufacturing data on Friday as well. So let's unpack it all with our Anna Wong. She is a chief U.S. economist over at Bloomberg Economics. Anna, have you seen the forecast change at all in the wake of the U.S. jobs report last week that showed the economy is not as resilient as many had thought?
Well, you know, I think that definitely in the past couple of months, the real-time jobs data may be exaggerating strength a little bit, and in fact, things are weaker underneath. But I also don't think the things are as weak as what the revisions show, which is that June only added 14,000 jobs. And I think next week with retail, for example, we're going to see a very strong headline. We are forecasting a 1% monthly gain in headline retails driven by car purchases, as well as this blockbuster of an e-commerce event in July.
So when it comes to how economists are looking at data, we've seen the economic surprise index show of late that economists were overestimating the strength of the economy and that the data was coming in weaker than anticipated. And of course, this is a self-correcting mechanism. When that happens, economists then tend to adjust their forecasts for other data points, and then we start to outperform again. Where does this leave us in terms of where economists see the economy headed?
Yeah, I think that is a good way to describe how economists have been surprised by inflation data. We are getting a CPI report next week, and I think this is one of the most important CPI report because it will determine whether there will be a rate cut in September or even whether a jumbo-sized rate cut will be on the table. And I think economists have been over adjusting their CPI forecast as a result of the past 4 months of downside surprise. I think this is the one where it will actually meet everyone's expectations, where we are going to see a hot print. And in fact, for the core PCE deflator, which is the gauge that the Fed cares about, I think July is going to see perhaps even a print that's touching on 0.4%.
Okay, so we'll wait to see how that shakes out. And of course, that will depend on how the CPI and PPI data come out on Tuesday and Thursday. Anna, really appreciate your joining us. Anna Wong is Chief U.S. Economist over at Bloomberg Economics. And that brings us to our market wrap on this Friday as we check out how the markets closed on the day and on the week. The S&P 500 did climb to record highs during the day, but did not close above that level. The Nasdaq 100, however, did, gaining 1% on the day. You have yields higher across the curve here, with the 10-year now at 4.289%. There was a lot of debt sales this week, treasuries as well as corporate credit sales. And of course, as Anna reminded us, some key data, including CPI, PPI, and retail sales. Spot gold currently little change, just somewhat lower, but it's been kind of all over the place today on confusion over the surprise, unexpected imposition of tariffs on certain gold bars. And then later on, Bloomberg reporting that the White House will clarify what it calls misinformation on those tariffs. This is The Close on Bloomberg. It's time for Next Up, where we highlight the entrepreneurs and trendsetters moving the needle in the markets and across the economy. Private jets are soaring in popularity as wealthy individuals seek to avoid crowded airports. Bombardier, which is one of the world's biggest private jet manufacturers, just logged its strongest quarter for business jet orders in more than a decade. Joining us now to discuss the private jet landscape is Jessica Fisher. She is founder and CEO of Flyjets, which is a global platform that helps individuals search for and book charter aircraft. Great to see you.
Great to see you. Thanks for having me.
So tell us a little bit about Flyjets and how it works. Is it comparable to, Airbnb, Uber, StubHub, these marketplaces that we're so accustomed to using?
Yeah, so Flyjets is a marketplace, and then we just launched a secondary exchange. So if we're talking about the marketplace, I would say Airbnb for jets, because an operator or an owner can list their plane like an asset, and someone can book. The difference between jets and houses are that jets are dynamic assets, so they're constantly moving. So we write algorithms to accommodate jets so that we're able to list them in their availability in real time, and pricing and accuracy can be listed in real time or updated every 5 minutes, depending on what the schedules of the aircraft allows. And anyone can go on, look, do a search, and book automatically, which is great because it's a great way to promote transparency and really to be able to see, here's the landscape of jets.
Right.
Here's what's closest to me. Here's what has the least reroute time. What's going to be most cost effective. What fits the preferences that I want. The exchange that we just launched, which is I call a secondary, it's a secondary exchange, is similar to StubHub, I would say, because I can take the same way that someone could take tickets to a concert. I could say, hey, I have a plane that's going from Teterboro to Opa-locka, and I want to sell 3 spaces on the plane. Flyjets, can you do this on my behalf?
I see.
So that I can make money back on the trip.
So, I mean, when I go to StubHub, I often go after the game starts, and I'm looking for a field level seat at Yankee Stadium, at about 7:05. Can you get a discounted price, or is everything at a premium pricing?
So yeah, there's certainly discounted pricing. We actually have a bid system. So there's an outright purchase price and there's a buy now price and a bid price. So let's say Teterboro to Opa-locka, 2 spaces on a Challenger 350, on a Bombardier Challenger 350, are going to be offered at $3,000 outright. Bidding could start at $1,500, and bidding is time-based as well. So we have a lot of neat things built in to really promote that electronic marketplace, electronic exchange functionality.
So because there's more transparency and you're making available all this supply on these seats on private jets, could seats become something where they're affordable in the same way that maybe not business class, but first class seats on commercial aircraft are?
For sure. We've had so many people come to us and say, maybe I'm traveling from St. Martin to an island in the Caribbean, and this is awesome because it actually ends up all in by the time I fly, let's say first class to St. Martin Airport, which I think is just a good example. And then I take another leg to whatever island, for instance, that I'm going to. It ends up being the same outright, especially when we can do things like creating 2 empty legs, which means I'm going to airport X, someone's coming back to where I'm going, and the plane has to go round trip no matter what. So 2 people essentially split the cost because the plane is charging round trip pricing no matter what. So we have a lot of cool functionality that volume supports, obviously.
Is there any regulation of this at all?
Yeah, so there are FAA rules when it comes to space sharing. The 2 primary rules, I would say, one is called, on demand. It's basically classified as on demand. So if there's no underlying contract, and you and I, for instance, want to fly to, let's say, Alaska together, and we group together, and we say, hey, let's speak to a broker, or let's go direct to an operator. We can both sign a contract. There are no restrictions on that. However, kind of like the futures market, right? If I have an underlying contract already, so I already contracted with an operator, technically I can't solicit spaces thereafter.
I see.
However, what Flyjets does, we have a partner brokerage that will do what's called Part 380 public chartering and make that legal so that you can go and say, hey, does anyone want to join my flight? So that's one of the cool benefits that the system offers, which is just to kind of help move this utilization needle along.
Right, and you mentioned the FAA. I should mention we have headlines crossing that say the FAA is proposing Newark Airport flight restrictions into October 2026. They're looking to cap Newark at 72 flights per hour, which is slightly higher than the 68 currently, but certainly not back to where it was before. Speaking of Newark, I know you mentioned Teterboro.
Yeah.
Do the problems that a Newark airport faces because of the shortage of air flight controllers affect private jet departures and arrivals at an airport like Teterboro? I mean, is there a spillover?
So in terms of air traffic controllers, there are a different set of controllers at Teterboro. So there is some overlap, but you have a separate, that operates separately. When it comes to TFRs, temporary flight restrictions, that just depends on the exact area that's included in the TFR. So that varies airport to airport and based on the specific TFR.
All right, fantastic. Jessica Fisher is founder and CEO of Flyjets. Great to speak with you.
Great to speak with you. Thanks for having me.
Thank you very much. Now, still ahead, we're going to tell you what investors need to watch for over the next week, including the potential for a box office boom. This is Bloomberg. Time now for the top 3, where we name drop the people driving some of the day's most talked about stories. And first up is Lip-Bu Tan. The CEO of Intel says that he has the full backing of the company's board. This after President Trump called for his resignation, calling the executive highly conflicted without giving specific details. Next up is Dan Snyder. The former owner of the Washington Commanders is now one of London's richest residents. The couple spending more than $67 million on a home in central London following his $6 billion exit from the NFL Owners Circle. And rounding out our top 3 is Gwyneth Paltrow. The actress and entrepreneur's wellness brand Goop Beauty is expanding. Starting this weekend, Goop is rolling out skincare products across 800 Ulta Beauty stores in the U.S. She says early standouts include the 72-hour supercharged hydrating water cream moisturizer, $68, and the daily detox foaming cleanser for $38. Now, two other people, a lot of people may be watching, or hopefully are watching if the studios have any choice about it, are Lindsay Lohan and Jamie Lee Curtis. Freaky Friday is back with the arrival of Disney's sequel called Freakier Friday, now in theaters. But will it be enough to boost domestic theaters' hopes for a late summer box office turnaround? Our next guest writes that the film is poised for a potential debut in the high $30 to low $40 million range. The PG rating gives it a huge shot at outperforming. Let's discuss now with Paul Dergarabedian. He is senior media analyst over at Comscore. So, Paul, one reason why you are hopeful for this movie is that it's a nostalgia film. Who actually is the audience that they're targeting? Millennials, Gen Z, or maybe the original Gen Xers who watched the Freaky Friday that aired in 1977?
Yeah, that's interesting, Scarlett, because I think the audience is incredibly vast for this movie. Having that PG rating means you could basically take the entire family. I think there is the nostalgia factor, and to think that Freakier Friday, the 2003 one, came out in 2003, doesn't feel like it was that long ago. And now with Lindsay Lohan and Jamie Lee Curtis reprising those roles, the 77 film, as you alluded to, Jodie Foster and I believe Barbara Harris co-starred in that one. John Ashton, I think, was in that as well. So it's really, I think, for audiences to go out this weekend, you have Freakier Friday, PG-13 Disney movie, and you have Weapons from New Line Cinema and Warner Brothers, the Zach Cregger movie. Zach Cregger directed Barbarian, a really eerie, scary horror movie. Weapons has a lot going for it. So I think these two very different movies, they're perfectly counter-programmed. Both are going to be going head-to-head. It'll be very interesting to see which movie comes out on top this weekend.
Certainly. And of course, there's also a good narrative when it comes to Freakier Friday, right? Because Jamie Lee Curtis has won some Oscars. You also have Lindsay Lohan really making this comeback after some personal and professional setbacks. That was like 18 years in the making. So there's a curiosity factor there.
Definitely. And I think that plays well in this month. I've talked about August as a movie-going month has been really cool over the years. Films like Body Heat, Apocalypse Now, Risky Business, Fast Times at Ridgemont High, Superbad, and Glorious Bastards. I could go on and on. I love the month of August. And this August is no different. There's some edgy fare coming as well, Weapons being one film this weekend. Caught Stealing from Darren Aronofsky coming out later this month. The Roses, Labor Day weekend. So I think this is a great final month of a summer that brought us films like Mission Impossible, Superman, Lilo and Stitch, F1, so many, How to Train Your Dragon, so many cool movies this summer. It's just boosted that box office.
I know, just you're naming some of those movies makes me forget just how long of a summer it's been, because it's been a while since I thought about Mission Impossible. You talk about Weapons. It's got this buzz, and I know a lot of it has to do with the director, Zach Cregger, but I wonder as well, because it's available in IMAX, talk about how horror movies match up with the big screen immersive experience that IMAX produces. What have you observed with regard to movie theater goers' willingness to pay premium for that experience?
Yeah, I think they are. And we've seen that in our Comscore data that the premium formats, all of them have seen a boost in box office, especially in the post-pandemic era, where while people are still price sensitive, if it comes to a movie like Weapons or even a movie, let's say like Dune, Mission Impossible, Superman, Fantastic Four, they want the biggest possible experience, and audiences are willing to pay for it. But I always say, if people get this reference, My Dinner with Andre would not really work in IMAX, but certainly Superman and Weapons and other films like that play very well. And then the fact that we have comedy right now making a comeback with The Naked Gun that opened a week ago, Freakier Friday, Spinal Tap is coming up, Spinal Tap 2. And so I think comedy on the big screen hopefully makes a big comeback. But what a month for movies this will be. Summer ends on Labor Day Monday. We'll be at close to $4 billion domestically. That's what I'm projecting at this point in our Comscore data is showing us right at about 3.2 billion through Wednesday of this week in terms of the box office. So a really cool weekend coming up. Something for everybody at the movie theater.
Something for everybody. So, Paul, when it comes down to it, at the end of summer 2025, what's going to be the big hit that you think is going to come out on top here?
Well, I mean, I look at a movie like Lilo and Stitch, which opened the same weekend as Mission Impossible. Those two films, Mission, Stitch, Possible, if you will, drove a record Memorial weekend, according to our Comscore data. And Lilo and Stitch is at over $1 billion worldwide. Some other great movies like F1's at $550 million, Superman at, I believe, $560 million, Jurassic World Rebirth at $770 million, and Lilo at over $1 billion. That, to me, is a pretty good global summer at the box office.
Yeah, you mentioned Lilo, and of course that's also a nickname for Lindsay Lohan as well. So thank you so much, Paul Dergarabedian, Senior Media Analyst over at Comscore, giving us a taste of what to expect from this weekend's box office. Freakier Friday and Weapons are coming out, and of course they're being closely watched. Let's look ahead to what else we have our eye on for the next week. A busy week, certainly for investors. FedSpeak gets underway with Michelle Bowman on Saturday, so even before we get to next week. And of course, CPI and PPI data out of China over the weekend as well. Investors will get to react to that first thing Monday morning. On Tuesday, the U.S.-China trade truce is set to expire, although the Treasury Secretary Scott Bessent has given an indication that that will be extended. Plus, we get U.S. CPI numbers for the month of July out, as well as earnings from Kava and CoreWeave. On a Wednesday, we will get more Fed speak from Austin Goolsbee and Raphael Bostic, as well as earnings from Cisco, the internet gear equipment maker, hardware maker. And on Thursday, wholesale inflation is due out with U.S. PPI for the month of July. Initial jobless claims, remember, continuing jobless claims have been rising, and that's been perhaps giving indication of a weaker than expected labor market. Earnings out of Tapestry, Deere, and Applied Materials will also be covering as well. And finally, that leads us to retail sales at 8:30 a.m. on Friday, and the University of Michigan Sentiment Survey to close things out as we close out this week for you as well. That does it for us. Balance of Power's up next. Have a great evening, everyone. This is Bloomberg.